All right, welcome to today's webinar. Our subject today is deferred compensation, using it to your advantage. Thanks for logging in. Really appreciate you being on board. Looks like we've got quite a crew today all over the state. Seeing people up in Jacksonville, that's pretty cool, in Pensacola, and as well as a number of people in South Florida. Looks like Fort Myers as well. Thanks for being on with us today. Hope we'll make it worth your while. So, listening to the webinar, if you're interested in the audio for today's webinar, it's being broadcast through your computer. I'm sure you're interested in it. Please make sure your speakers are turned on or your headphones are plugged in. You can also control the audio broadcast via the audio settings at the bottom of your screen there. We also have Q&A available, so please use the Q&A icon to submit any questions that you have during the webinar. We'll answer your questions directly or even live on the air. May also ask questions. You may also ask them by just emailing me at alan@northstarplanners.com. And I am Alan Giese, the founding partner and the president of North Star Financial Planners here in Plantation, Florida. That's in the Fort Lauderdale area. I'm doing this for 27 years. And back in 2000, 18 years ago, my how time flies, I founded North Star Financial Planners as a full fiduciary fee-only financial planning firm. So what that means to you is that we don't sell any investment products. That makes us as unbiased as it gets in this world, since we're not trying to get you to buy something. All we want to do is make sure that you have the very best advice available. We currently manage client assets of over $150 million, and we are focused and have been focused on FRS special risk retirees since 2006, when one of my closest friends, Battalion Chief Gary Gonzalez, came to me and asked me what he should be doing with his FRS plan, and that was the start of it all. Today we have worked with hundreds of FRS special risk retirees. So today's webinar objective, we're going to really dive deep into learning what the strategies are that can increase the effectiveness and the benefits of your deferred comp plan. And, you know, it's really a special thing you guys have as FRS special risk employees, and is a marvelous tool that will allow you to have a much nicer retirement if you utilize it well. So in the last 10 years or so, we've been, doing this in actually about 12 years. And in that time, as I mentioned, we've interviewed hundreds of retirees and pre-retirees in the FRS special risk world. Some have used their deferred comp plans very well, and it's helped them transition into a enhanced retirement lifestyle. And their deferred comp plan gives them this additional level of flexibility that just gives them more options down the road. Tell you, when I'm working with a new prospective client, somebody has come to us for help and is asking, what should we be doing? And I don't see, especially if they're just at the cusp, just about ready to retire, if I don't see a healthy 457 plan as, in their mix, my heart sinks a little bit, because I know that they're not going to have the same level of choices that somebody who has been focused on their 457 plan. So I'll tell you what, if there's one thing you could do, if there's one thing you can take away from today's chat here, is that if you're an older guy, you're 20 plus years into the system, talk to some of the younger guys and gals and tell them, this is a serious thing. You definitely want to be utilizing this thing well. The earlier you start, the better off you're going to be. And if you're a younger special risk employee and you're not utilizing it, I'd say you're really missing the boat here. So let's talk about why. What are you missing the boat on? The first strategy, and I'm going to set this up as strategies, like a half a dozen ways that you can use the 457 plan to make your life better. So one is, when you utilize your 457 plan, you're lowering your current income taxes. Everybody likes to pay less taxes. Well, here's a way to do it, and it's simple, and it helps you out, not just in the taxes this year, but it helps you out for the future person you're going to be. So it lowers your taxes, increases your future retirement benefits. All your contributions, of course, are going into the plan on a pre-tax basis, which is why it reduces your taxable income. And what's more, once that money is in your plan, any growth on that money over the next however many years it's in there is all tax deferred. It's growing without being taxed along the way. That's a very, very powerful benefit. I like to think of it this way, and I think this is a good way to think of it, in that it's not so much that you're cutting your paycheck today, you're taking some money aside and you're advancing it to the future person that you're going to be. And when you use those dollars, whether it's you're 1 year away from retirement or 20 years away from retirement, that's when you're going to get taxed on them. So you're pushing that tax down the road. You're also pushing that money down the road. So you can use it for some really wonderful things. We've seen police officers and firefighters use their deferred comp plans for some really wonderful enhancements for their families. The maximum you can put into your deferred comp plan is $18,500 a year. This gets adjusted a little bit most years, to account for a cost of living increase. If you're 50 or older, and we'll talk about catch-up provisions in a little bit, but if you're 50 or older, you can put an additional $6,000 in. So that puts your limit up to $24,500. There's some serious savings going on here. At a 24% income tax bracket, which is where most of you seem to fall, based on the new tax law that came out in late 17. That's almost $6,000. That's just like Uncle Sam writing you a check for $5,880. That's the real cold hard cash savings you get in your taxes. That is nothing to sneeze at, and compound that year over year over year. That's a lot of money, folks. So hopefully you're thinking to yourself, well, gosh, I want to max this thing out. I want to use it as, to the limit, and which I'd say, hallelujah, more power to you. But, how much does that mean? So if you're less than 50 and you want to max it out, that's $711 per paycheck. Now I'm assuming you're in 26 pay periods, a biweekly paycheck. But it's not really $711 to you, because remember, this is pre-tax money. So that means the net effect to you, what it actually feels like to you, before the tax hit, is $540. That's the loss of income, current income to you, not $700. So think in those terms. You're not. It's an immediate tax benefit that you're getting, and you're seeing it in your account immediately. Now, again, that's assuming a 24% bracket. If you're 50 or older and you're utilizing the catch-up provision, that pushes you up to $24,500, which pushes you up to $942 every 2 weeks. That's some nice savings. You can really do some nice things with that in retirement by pushing that money forward. All right, so let's move on to the next strategy. And remember, if you have any questions at all, there's you can use the Q&A icon, and we'll be glad to answer them for you here live. So next strategy is to avoid double taxation on your 457 plan. Don't use the loan option. And I can almost hear you all right now, or most of you. I can just hear a collective, what? That loan option's awesome. It's a great way for me to use money for, upgrading my home or getting a new kitchen or whatever the deal is. It's not, all right? I'm going to explain it to you. It's a horrible way. You really don't want to utilize. I know that, in stations and firehouses, the conversation is, well, you need extra money, just take a loan, on your 457 plan. And, the benefit is that you're paying yourself back the interest. Yeah, but the interest is the least thing on there. The tax you're paying makes the interest look like nothing, all right? I'm going to show you how this works. So, yes, you're paying Uncle Sam twice on the same dollars. let's set up a scenario here. Let's say you're redoing your kitchen, all right, $25,000. I don't know if that's enough for a kitchen or not. That should be. 5% is the loan rate. The deal is you pay it back over 5 years, which is 60 months. So if you did your math, you're going to find out that a $25,000 loan amortized over 60 months at 5%, it gives you a $471.78 per month loan payment. So now you're thinking, I know most are thinking, that great, I'm paying back $471, it's coming out pre-tax. It's not. This is not a contribution to your 457 plan. This is a loan repayment. This does not come out before your check gets taxed. It comes out after tax, all right? So there's a tax that's occurring right there. So how much do you have to earn to put $470, we're just gonna call that $472 back in your 457 plan? Again, at that 24% tax bracket, you have to earn $620 to net out 471. All right, so now multiply that times 60 months, and you're going to earn $37,000 to pay back $28,000. Yes, you paid back that your loan was $25,000, so at least 20, with interest that's $28,000 that you paid yourself back, but the tax was almost $9,000, folks. You paid yourself back the extra $3,300, but you paid on that $37,000 $8,900 in taxes. All right, and you're not done yet. All right, you still got taxes ahead of you on those same dollars. Let's say it's the first day of retirement and you immediately take out that $28,307, just to make it simple. All right, that $28,307, the IRS, it's like they think it's never been taxed. All right, because it's coming out of your 457 plan, all of it's subject to income tax as you take it out. So they're going to tax it again. All right, second time it's getting hit. So that's another $6,700, almost $6,800 in taxes. Add those two taxes together, the 89 and the 67, and you've paid $15,733 on what you had to earn was $37,000. All right. I mean, there's an argument you could say it's on 28, but the reality is you have to look at the whole amount you earned. And in that scenario, you're paying 42.2% taxes. That's big. That's huge. That's like twice as much as you should be paying in taxes. And, if you do this, I'm going to thank you as a citizen of the United States, because you paid more than your fair share in taxes, and hopefully we'll see it in better education and roads and everything else that tax dollars go towards. So thanks for more than pulling your weight if you're taking a loan. Now, as a financial planner, and we're always interested in the whole health of our client and doing what are the right decisions for this particular client based on their total makeup. To us, it signals an inability to live within their income means, which is usually a recipe for disaster. All right, it usually means this is a person that's probably going to outlive their money, and we all know what that means. That is not where you want to be. So it puts that forward. And if that person is trying to decide between the pension and the investment plan, it's a huge red flag on going ahead with an investment plan, because it means we're probably going to be dealing with somebody who is going to take out more than they should, in all honesty. There's so much behavior behind financial planning, and this is one area that a seasoned, well-experienced financial planner would point at and say, yeah, I don't know, if you're taking loans and you want to take the investment plan, are you really going to be disciplined enough in that, because you apparently haven't been disciplined enough to live within your income means prior to this. So it is a red flag. So I'm really harping hard on this, right? Should you never take a deferred comp loan? No. I mean, if it's dire and there's just no other resource, you've already tapped out all the equity in your home, surgery is impending, you have to do it, it's your mother, whatever the deal is, worst case scenario, this is your avenue of last resort, and leave it that way. Don't make it your first choice for additional funds to buy the Winnebago. All right, not a good idea. Or the retirement property in Tennessee or whatever it is. This is not where you want to get those dollars. Okay, moving on. Strategy number 3, utilizing further tax benefits by using the catch-up provisions. All right, so there are 2 catch-up provisions that you need to be concerned about. All right, one, we haven't mentioned this one yet. The other one we mentioned is the double limit catch-up. All right, the double limit catch-up is available to you within the last 3 years of your retirement. So you've decided you're at least 3 years away, or no more than 3 years away from retirement. You go to your benefits administrator and you say, hey, I want to start my double limit catch-up provision. This is an amazing benefit because it doubles the amount that you can contribute into your 457 plan. And here's the fine print based on your history. If you have maxed out your 457 plan, and y'all know the 457 is the same as deferred comp, all right? So those are terms we use interchangeably. But the 457, excuse me, what was I saying? Oh, so this increases your benefit to 37,000 only if you haven't maxed out your 457 contributions every year prior to that. If you came out of the department and your first day of working, you signed up to max out your 457 plan and have maxed it out every day since, you cannot do this double limit catch-up, all right? Not too many people are in that category. So for almost everybody that we come across, the double limit catch-up is definitely an option. And you're going to see why you want to do this in a minute. Check with your municipality because different municipalities interpret exactly when retirement starts. All right, if you're especially, well, it's only where the drop is concerned. Some municipalities consider it at the end of the drop. Some municipalities consider it at the beginning of the drop. Our experience for most municipalities is that it's at the beginning of the drop. And that's important because you want it to coincide with your annual leave payout, you know, as you go into the drop. Because what we want to use this provision for is to protect that leave payout, or as much as we can, from obviously being taxed. So check with your benefits officer no less than 3 years before you drop or retire. The other catch-up provision is the age 50 and over catch-up. There's an additional 60,000, or 60, boy, I wish, right? There's an additional 6,000 that's available to you there, and that is not dependent on you having maxed out. That's just because Congress a few years back decided, you know what, everybody's behind, and we want to give them the ability to save more. So at 50, let's bump that number up, and that also gets adjusted sort of annually. It doesn't go up every single year, but it goes up, you know, every now and then. So here's a question coming in from George, or maybe it's Jorge in Miami. Jorge says, if I only have 1 year to retirement, can I still do the 3-year catch-up? Right. Okay. Yeah, absolutely, Jorge. Yes, please. Yes, you can go ahead and you know, contact your benefits people right away and tell them, hey, I'm 3 years away. I probably would just say I'm 3 years away. I mean, you don't have to tell them it's only a year. Let me start my double limit catch-up provision, and they'll get you on the books for that. Okay, going forward. Yes, you cannot do both of these things. If you are you know, participating in the double limit catch-up, you can't add on an additional 6,000. All right. So why do you want to utilize the catch-up provision? Well, I probably already, you know, pretty much mentioned that, but you want to avoid taxing those payout dollars. At 24%, that's $4,400 in tax savings on that second $18,500. That's $8,800 on your total contribution that year. Again, that's a check coming. That's just like a check coming from the government to you for $8,800 or $4,400. And, you know, I don't want to overlook the fact that you're also pushing that money down the road to the future person you're going to be. You know, even if you're just doing it, let's say you're 1 year away from retirement, even if you're just pushing it down the road for 1 year, you know, you plan on using it for, something wonderful next year, you're pushing the tax into next year, which is anytime you can delay a tax, it's a good thing. All right. So use it, definitely. All right, next strategy. Strategy number 4, use your plan for effective income strategies prior to age 59.5. This is where we see options for guys and gals that have used their 457 plan versus no options for people that haven't used their 457 plan. You can use your 457 plan to help you avoid early distribution penalties from your other plans or being forced to set up a 72T withdrawal plan. So real quick, a 72T withdrawal plan, not too many people are aware, but if you're not 59.5 for most qualified retirement plans like 457 plans, well, 457 plans is actually the exception. That's why we're going to use it. Like 401k plans, IRAs, things like that. If you're not 59.5 and you begin distributions, the IRS says, well, too soon, we're going to penalize you 10%. It's an early distribution penalty for accessing those funds prior to the age of 59.5. Don't ask me why it's 59.5. I have no idea. It's been 59.5 for decades. All right. So the 457 plan is the exception to that rule. You don't have to pay. There is no 10% early distribution penalty from your 457 plan from everything that you put into your 457 plan. So if you retire at 48, doesn't matter. You can still withdraw money out of your 457 plan. So now here's a planning technique or strategy that's often used. It's like, well, why don't I take my drop proceeds or my investment plan or IP proceeds and put them into my 457 plan, which you can do. And therefore, that money would no longer be subject to the early distribution penalty. Maybe, but it doesn't always work because there's a couple of additional rules to be aware of. One, if you roll over your drop proceeds, you can only avoid the early withdrawal penalty if you separate from service the calendar year you turn age 55 or later. So if your birthday is in June, you're going to be 55 in June, and you retire January 2nd of that year and roll over your drop into your 457, yes, it is available to you on a pre-tax without the early distribution penalty. All right. If you retire in November, the year you turn 54, you turn 55 in June of the next year, the following year, and you roll over your drop proceeds, it is not available to you and avoid, you can't get it and avoid the early distribution penalty. We have been in conference with a couple of people now that were in that scenario. They were ready to pull the trigger, and we said, wow, just work another 45 days, just get past the first of the year, and you'll make all of that money available to you without having to pay the 10% penalty if you take it out before 59.5. The look of surprise was kind of amazing, on their faces. So going to the IP plan, if you roll over your investment plan proceeds, you do avoid the early distribution penalty if you separate the year you turn 50 or later. So you got to keep those two things separate. Drop proceeds are treated differently than IP proceeds. If you have any questions on that, by all means, feel free to give us a holler. Now, transferring the drop or IP proceeds into the 457 may allow distributions to not be subject to the early distribution penalty of 10%. All right, strategy number 5, use an effective investment strategy. All right, so this is where we see probably the biggest mistakes or biggest misunderstandings or least effective ways of using the 457 plan. We've seen people who are very scared of the markets and just put all of their money in the fixed account, which is really not utilizing things effectively. We've seen other people not really understanding how much risk they're putting in their account and kind of going for it, like, throwing down the bet and hoping, the 7 comes up. So I want to talk to you for a few minutes about strategy, investment strategy. And this is really pretty easy, folks, having an understanding of how to properly invest your 457 account. First off, you want a strategy that coincides with how long you'll have the account. So for example, if you are going to have the account for a very short period of time, and you're going to cash out within the next year, and you need the money desperately for some reason, you don't want to take any risk with it. So you want to make sure, but you want to make sure that you're not risking those assets, because you could, find out that the day you need the money, it's not all there because of, investment performance might be down at that point in time. But if you've got a strategy that might be a decade long or decades long, then you want an investment strategy, and that's most of you. Then you're going to want an investment strategy that coincides with that. Now, over that time period, there's going to be up markets, there's going to be down markets. So your strategy has to make sense in all kinds of markets. One second. Not used to talking this much. Your strategy needs to be evidence-based. There's basically 2 camps out there. And I think of them as being sort of the Wall Street camp, which is really there to sell you product. This is all the investment advisors and brokers that are out there trying to sell you mutual funds, life insurance policies, annuities. They make their living selling stuff, just like car salesmen selling cars, all right? If you don't sell a car, they don't get paid, their kids don't eat. Same thing is true with most of the investment community. If you aren't buying an investment product, their kids ain't eating. It's that simple. Their strategy is a little different then, because they're focused on transactions as opposed to what the academic world sees. The academic world sees how the investments, how markets work a little bit differently and bases their advice on that. That is what you want to be focused on, not the focus on buying and selling investment product. So it needs to be rooted in science, not speculation. So our recommendation is to use a strategy that doesn't require any sort of market timing or picking good stocks over bad stocks. We call that stock picking. So we're an investment firm here at North Star, and our clients depend on us to give them sound advice into what they should be doing, with their investment dollars. All right, so let's get into this. First thing I want to show you is this. This is really kind of an amazing study I look at every year. It's from a firm called Dalbar up in the Boston area. And this is just a slice out of their study. It's the 20-year snapshot. They do the same thing every year. They say, what's been the experience in the U.S. markets over the last 20 years? And let's annualize that performance. And so they say, you know what? Over that 20 years, the big companies in the United States have returned at 7.2% per year. Average. So that's that's pretty good, especially when you stop and think, wow, that includes the tech bubble bursting and nearly a 50% drop in U.S. stocks in 2001, 2002, and the major market fiasco we had in global market fiasco we had in 2007, 8, and 9. Even with those factored in, we still did 7.2%. But then this is what Dalbar is really interesting, is like, well, what did U.S. equity investors actually get? Like, what was their average? And the difference, this last year was actually one of the closest years I've seen in a long time. It's usually a bigger spread than this, but it's still pretty significant. Average U.S. investor got 5.2, and he's leaving a lot of money, and she's leaving a lot of money out on the table out there. So in other words, it's this simple. If they had just bought all the stocks and gone to the beach in 1998 and didn't come back until 2017, like, they were, on a deserted island for the whole time, they got 7.2%. It's that simple. The guy that was here the whole 20 years and trying to pick and choose the right investments and market time and all that kind of stuff, he got 5.29%. Big difference. In dollars, that's a huge difference. And the bond side of the world is even more disgusting. I mean, really, it's the average bond return was 4.7%, 4.6%, but the average bond investor got something less than half a percentage point. I'm going to jump to the conclusion on this. It's their behavior. That's the difference. These people are not behaving well, all right? The average investor does not understand how markets really work. So I'm going to hit 10 points, and they're not laborious. We're going to go through this quickly, but here's the 10 things you want to be aware of, all right? First, you want to embrace market pricing. All right, with every trade out there, buyers and sellers bring new information to the marketplace, and that helps set prices. Now, no one knows what the next bit of information is going to be, but the future is always going to be uncertain, but prices are always going to adjust. Now, it doesn't mean that the price is always right. All right, there's no way to prove that, but investors can accept that the market price is the best estimate of the account value of what that thing ought to be worth. So if you don't believe that market prices are good estimates, if you believe the market has it all wrong, you're pitting your beliefs and your hunches against the collective knowledge of basically billions of trades on a daily basis, all right? So there's a ton of information out there that's available at any instant in time, and the world equity trading amount is $407 billion per day. All that information filters into the price. It makes me think of the show, The Price is Right. The price is right, all right? That's all the information tells us. So don't try to outguess what the market's going to do. You know, we look at the professional world of investing, all right? So let's take mutual fund managers. These are highly paid investment gurus that are given huge amounts of money to invest for us as investors. And when we look at their performance, it's really not very good, folks. So if in 2003, this is a 15-year snapshot, we see how many equity funds were out there. There were 2,828. And of those, 51% are still around. So half of them just, I mean, they crapped out. They're gone, all right? 14% beat the market. This is almost exactly the same number that you would expect purely by chance, all right? So here's the thing, trying to figure out in 2003 who that 14% was going to be. Of those names, picking and choosing who was going to end up being the winner, good luck. You know, if I knew that, I probably wouldn't be here on this call, right? I'd be really, really wealthy, you know, because if I had that ability. But the reality is we don't know anybody that has that ability. And same is true on the fixed income side. You know, the numbers are, you know, pretty similar. All right, so resist the temptation to chase past performance. So what's the first thing you do when you get your 457 plan, right? And you're trying to decide what funds to pick. You look at the performance of the funds. Don't, you know, I know y'all do that, all right? Don't do that. It tells you nothing. It's worthless information. It's actually less than worthless. It actually hurts you. When we look at past performance and then project future performance against that, we see that top 25% funds are in that top quartile. How do they stay on top? About a quarter of them do, or maybe a third if it's a fixed income fund over the next 3 years. That's not very good. Those are not good odds, all right? Trying to pick, you know, funds based on past performance is not that, you know, 75% of them trailed, you know, after that. So no, you don't want to do that. So don't look at past performance. Just embrace markets. Let the market work for you. There's areas in the financial markets where there's a reward for taking maybe additional risks. So stocks versus bonds. Stocks have a higher risk, but there's a significantly greater reward. If we look at $1 invested here in 1926, what's that dollar worth today based on various investments? Well, if you bought long-term government bonds, which is kind of the, you know, the better part of the bond world, longer-term bonds, that dollar is worth $143. Wow, that seems pretty good, right? It grew 143 times. Well, if you just put it in US stocks, large company stocks, that 143 changes to 7,347. And if you put it in small company stocks where there's more risk, but the market seems to be more than willing to pay you for taking that risk, that $1 grew to almost $23,000. Multiply that times your $711 per paycheck you're putting into your 457 plan. And you're starting to talk about serious growth in there. This is one of the areas where the academic community has identified, hey, you know what? This is a risk. Yes, short term, there's risk. Long term, there's reward. It's worth taking. So what other areas have they identified like this? All right, so, and this is kind of the big secret, folks. This is what drives performance, nothing else in your portfolio. It's not your ability to pick stocks. There's tons of studies that just prove that. It's not the ability to see and forecast what markets are going to do and try to sidestep and avoid them. These are the things that tell us how your portfolio, how your 457 plan is, how it's going to perform going forward. So, you know, first, how much exposure is there to stocks versus bonds? Then of your stocks, how much of the exposure is to small companies? How much of the exposure is to value companies or companies that are basically not doing that great today, but future performance seems to be considerably better than the rest of the market? And then of the companies that you're investing in, what's the profitability of those companies? Because we do know that companies that are currently profitable have a tendency to remain profitable. A significant amount of them continue to remain profitable for in future years. So identifying those, you know, your exposure to these four areas, really it's these three areas, you know, in the equity side, because, you know, this tells us we're in equities, tells us how well the equity side of your portfolio is going to do. On the bond side, term and credit is really where the risk is. The longer you hold bonds, you know, the longer your mutual fund manager holds bonds in your 457 plan, the more risk is there. There's a greater reward. But the whole key here is risk is measurable. And we know that if we took a bond portfolio that had that much risk and an equity portfolio that has exactly the same amount of risk, you're going to get paid more on the equity side over the long haul than you will on the bond side. All right, so if you have any questions on that one, by all means, you know, we're here. We love to talk about this stuff, but I feel like I'm probably belaboring the point a little bit. Next thing you want to do is you want to practice smart diversification. You want to spread your money out. Don't put all your eggs in one basket, right? I mean, your mom probably told you that, or your dad probably told you that. So I'm still amazed when I see prospective clients walk in here with their investments, and all they have, in my eyes, is one thing. Even though there might be 200 or 300 stocks in their portfolio, they're all the same kind of stocks, all right? So there's no real diversification because it's kind of like having one flock of birds. They all kind of move in tandem. Owning, you know, all big company stocks in the United States really is one thing, all right? Even though you might own 300 of them or even 500 of them. If you can just spread those markets around, if you own small company stocks, own stocks in Europe and Asia and Far East, of course, and own, you know, bonds in there, get as many asset classes as you can in your portfolio. And that really makes a difference because you don't know which asset classes are going to overperform and which ones aren't. You can't tell ahead of time. So going back to the last 15 years, if we were just to rank, you know, which asset classes came in first and which ones came in last each year, and then color code them like this, and then stand back and look, you immediately realize it's completely random. There's no pattern going on here, all right? And then the next thing you want to do is you want to avoid, you basically want to get your emotions out of it, because as, you know, we start investing, we become very optimistic, right? You wouldn't be investing if you weren't optimistic. Hopefully you have good market performance and that optimism turns into, you know, you're now elated, right? You're very excited. Then, you know, the market starts turning and you start hearing bad news out there. You start getting a little nervous, all right? But yeah, you're okay. You're gonna hold pat a little bit. But then something big happens, all right? Or there's a big drop in the market over this week or month or quarter or whatever. And now that nervousness has turned to fear. And when you hit fear, fear is the motivator. Once you've hit fear, it's kind of like all bets are off. You're done. That's when people make really bad decisions. All right. And then once the world gets back looking good again, then they come back in, but it's too late. They've already realized their losses, and it's a great way. You remember that very first chart where the U.S. market did 7.62% and the average investor is 5.6? This is why. All right. So look beyond the headlines. The best thing you can do. And I tell a lot of clients of ours, I said, you know what, you've got more important things to do than focus on your investment portfolio. We'll take care of that. You focus on what you want to do. Don't worry about those crazy headlines. They're out there to scare the living bejesus out of you. All right. Focus then on what you can control. All right. So to have a better investment experience, you need to focus on those things that you can control, like create an investment plan that fits your needs and risk tolerance. So decide early on, hey, you know, I'm in my 457 plan for the next 15, 20 years. I know we're going to go through probably 4, maybe 5 pretty nasty markets over that time. So what would be an investment plan that you know, I don't have to make wholesale changes every time the market has a downturn. You want to structure your portfolio across these different dimensions of expected return, small cap over large cap. You want to make sure you've got some small cap. You want to make sure you have some value in your portfolio. Avoid the things that, you know, have excess risk but don't have a history of paying for that. Diversify your account, you know, globally. Don't just buy U.S. mutual funds in your portfolio. Manage your expenses. Really focus on, if I've got 3 choices in my mutual funds for my U.S. fund, one's charging 1.5%, one's charging 1%, one's charging 0.5%. I'm going to tell you that 0.5% fund is probably your first choice. That probably is the one you should be investing in. I'd be really surprised if the 1 or 1.5%. And if you have any questions on that, by all means, give us a call, and we've gone through so many of the different municipalities' 457 plans. Stay disciplined. Stay the course. You know, stay on tack. All right. So what's the next strategy? The last strategy we've got is to use your self-directed account, these SDO accounts, wisely. So I know a bunch of you right now are going, what's an SDO account? Many of you have 457 or deferred comp plans with Nationwide or ICMA that have access to a brokerage firm like Schwab or TD Ameritrade that you can migrate your money to. It's sort of like digging a tunnel from Nationwide over to Schwab, and you can move your money from your 457 plan into this new Schwab account. It's still under your 457 plan. It's still protected from taxation. It's still your 457 plan. You just have an account. You have 2 accounts now. One's at Nationwide and one's at Schwab. So a lot of guys and gals will use this Schwab account or this SDO account for stock picks, because, you know, they're out golfing and their buddy gives them a tip, and yeah, you got to buy, you know, this company because it's ground floor opportunity. And so this is a way you can do that in your 457 plan. That's a horrible idea. You know, that's speculating. Why speculate when there are strategies out there that you know will get you there? All right. You don't have to take those kind of crazy risks. So you want to use your SDO account to enhance your choices offered by your core account. Your core account would be like your Nationwide or your ICMA account. So by opening up your opportunities at Schwab, now instead of having, you know, 20 choices at Nationwide or whatever the number is, you've got now, I mean, realistically, you've got like 10,000 choices. That can be good, you know, and it can be bad. It can certainly offer a lot more opportunities, you know, for growth, but can also offer a lot more opportunities to get tripped up. All right. So kind of know what you're doing. And if you're using an SDO, definitely have an investment strategy that you know you can stick to. Nick in Jacksonville is asking, how do I find out if my plan has an SDO? Ask. Just call up Nationwide and say, hey, I heard this thing on this webinar about SDOs. My 457, do I have it? I can tell you if you're at Nationwide or ICMA, you almost certainly do have it, but not every single municipality offers an SDO. Okay. Consider stress testing your plan. Before I go into this, there's one more question came in. This is Russ in West Palm. Russ is asking, do you guys have experience with 72T, and have you helped clients actually set it up? Yes, that's a great question. 72T, all right, so again, this was earlier, about halfway back. We were talking about avoiding the early distribution penalty in your like your drop account or IP or an IRA or anything like that. So you get the early distribution penalty is if you're less than 59.5. So the IRS says there is a way to avoid having to pay that even if you are less than 59.5. But you have to follow their rules, like to the letter. Every period's got to be dotted just exactly the way that they want it to be dotted. There's a number of different ways. I can't remember how many. It's like 7, 8, or 9 different ways that you can access funds pre-retirement and avoid the distribution penalty, like first-time home buyer, medical care costs. There's education costs. Those are ways. But again, read carefully Section 72T of the Internal Revenue Code. But the thing that we're talking about is the ability to set up a payment plan to yourself out of your 457 account. So there's a lot of talk of, or not your 457, out of your IRA, IP, or drop account. I hear a number of advisors talking about this. Very few really, we find, have had live experience with clients going through there. Record keeping is key. You absolutely want to make dead certain you've got total complete records, because starting a 72T plan, which basically is a 5-year payment plan to yourself, either 5 years or 2 age 59.5, whatever's longer. So if you're 55 years old, you've got 4 years till you're 59.5, you have to go at least 5 years of paying yourself out of your 457 plan, an equal amount based on a formula and tables and all this kind of stuff. So it's very exact, very precise. But it doesn't trigger an audit by doing this. But if you're audited, they will definitely be looking into your 72T and making sure it's done exactly right. Having records makes a tremendous amount of difference, because the IRS obviously is going to be pretty demanding. We have experience there. So by all means, if you have any questions at all about setting up a 72T plan, we can help you there. So consider stress testing your plan. That was a great question, by the way, Russ. Consider stress testing your plan. Complete analysis. We will help you stress test your entire plan, not just your 457 plan. We will offer you a complete analysis from a fiduciary level advisor's perspective. Remember, that's different. We're not an advisor that we have nothing to sell you. There's literally nothing we can sell you. All right. We're here to really just find out, what's the best thing you could be doing. So we start in many cases with stress testing. It's like, well, this is what I'm doing now. We're looking for a way to do it better. All right. We're always challenging. This includes the recommendation on the optimal allocation for you based on your objectives and goals. We also will do a gap analysis of the complete financial situation based on your goals. Where are you now? Where do you want to be? And, what do you need to do to get there? What's the gap? How do we fill that gap? We'll answer any financial or retirement question you have. I don't care if it's about the pension, the IP, deferred comp, investments, mortgages, insurance, taxes, you name it. We will focus on whatever whatever questions you have. So this is something that we view as being a minimum of 5 hours of our time. Our hourly rate's $150 an hour. We're offering you, because you're on this webinar, we're offering this to you, or if you're listening to this webinar, free. All right, no cost to you other than your time. And I'm not going to belittle that your time is not valuable. It is valuable. Our time is valuable as well. But we're offering you this complete stress test at no charge. The not so fine print on this is that you got to call or email to schedule the initial consultation. That consultation will take about an hour. Could bleed into an hour and a half. I mean, we're really going to ask you a lot of questions, because we can't give you recommendations until we really know the whole complete picture. So you have to be able to provide us complete financial information that we ask for. And we're going to ask you, I'll tell you right up front, we're going to ask you for your last year or two's worth of tax returns. We're going to ask you for your will, or if you have a trust that you've done. We're going to ask you, obviously, for all of your financial information. If you've done any like a P&L or a balance sheet for like a mortgage refi lately, we're going to want to see that. We need a complete picture before we can give you any recommendations in good faith. You also have to be an FRS participant or retiree. This is not something we do lightly, and we're really focused on FRS folks. You have zero obligation to proceed beyond. You know, once we come back to you with, hey, you know what, this is what we think you ought to be doing, this is what absolutely has to be on your radar, we're not even going to ask you to hire us. If our information's good, we kind of think you're probably pretty smart, and you'll figure it out and you'll say, I like these guys and I want to work with them. And then we'll talk about what that means. But there's no cost to you, again, other than your time. Why do we do this? I mean, this seems ludicrous, why we would offer this for free. This to us is an investment in our future as well as your future. We know we've been doing this a long time, as I've said. I mean, 12 years with just FRS people. I'm 27 going on 28 years, you know, in this business. The numbers don't lie. We know a significant percentage of people that we stress test end up becoming clients. And so it's pretty predictable. You know, the other thing is, I'm a big believer in karma, future referrals. We give a lot of stuff away for free. This webinar right here is free. Hopefully you got something, you know, significant out of this, and it's really helped you, and it's not costing you anything other than your time. So we found that we end up getting a lot of referrals to future clients. Just this morning we were working with a gentleman whose his son is a firefighter, and dad is not a firefighter. But he's retired. He's done quite well, and was not getting the greatest advice. And the son had been to, I don't know, maybe a couple of webinars. Son's not even a client, but had referred dad, and now dad will probably be our next new client. So if you have any questions, looks like that takes care of, let me see. I don't know if I answered this one. Liz in Vero. Liz is saying, if I have a loan already, is there any way to avoid double tax? Wow, that's a great question. I don't think I answered this. No. Oh, Liz, yes, actually, there's a way you can avoid double tax. Retire. So let's say you retire with an outstanding loan. You separate from service. You don't have to pay that loan back. It just becomes income to you. So you're going to pay that income tax anyway on it. So just don't pay it back. You can pay it back if you want, then you're going to pay income tax on it again. But yes, that's really the only way I can think of off the top of my head. Liz, if you send me back your, or we probably have your email when you're registered. If I think of anything else on that, I'll certainly let you know. Yep, that looks like all the questions we've answered. So if you have any additional questions that occur to you later on, or if you're listening to the rebroadcast of this, then by all means give me a call or shoot an email over, and we'd be glad to help you out. So there's a number, 954-693-0030, and you can reach me on the World Wide Web at alan@northstarplanners.com. Thank you for spending your valuable time with us today, and be safe out there.